This is the first part of our study of the different types of business organizations. There are many types of business organizations, but we're going to limit our discussion this week to the primary major categories that are common in everyday life. So the first part we're going to talk about is partnerships. So with business organizations, there are multiple legal forms that you can use to structure a business. If you're setting up a business, you could have it as a sole proprietorship, you could have it as a partnership, and even at that, there are multiple forms of partnerships. You could have it as a corporation, and again, there's multiple forms of corporations, or you could have it as a LLC, a limited liability company. And we'll discuss these as we go through the examination of this chapter. So, in helping decide exactly which legal form to use, the book notes four primary factors that businesses or that the owners consider when developing their business. And these four factors are the legal liability of owners. As we'll see, some forms that may be used have limited liability in that it protects the owner from personal liability. But there are other forms of the business that may be other forms that could be used in which there is personal liability, meaning that there's no shield between you and the legal liability. If something goes wrong and someone sues and is entitled to recover damages, if there's no gap, if there's no protection there, then you could be personally liable, meaning that they could come after your personal bank accounts, the equity in your home, your paid for cars, things like that. But if you have a form of limited liability, then you're going to be protected in the instance that the business is liable to somebody for some wrong. Another consideration is what form is most attractive to others. As we'll see, the benefits the advantages that come with the different forms may be preferable to the people that are setting it up, or they may believe that it'd be um, more attractive to potential investors or to employees. And that may influence their decision to use what legal form they use. Another consideration is cost. As we'll see, there are some default types of organizations in which you don't really have to prepare paperwork, you don't have to prepare documents to create the entity, you don't have to pay filing fees with the state. So cost could be a factor that could help determine which form of legal entity you choose. And a last factor is taxation. As we'll see, there are some forms that have single level taxation, and there are some that have a double taxation. And when we say single level of taxation, the business itself is not a taxable entity. In those scenarios, the profits or losses of the business are passed through or flow through the entity into the owners personally. So any profits would be reported on the personal income tax of the owners. You wouldn't have a legal entity filing and paying taxes. But in certain entities that have double taxation, both the owner is going to pay taxes on what's earned, and then the corporation or, as we'll see, the entity will pay a level of tax as well. So there's two payments of tax, both the business entity is paying tax, and then the owners are paying tax. In a single level taxation model, only the owner is paying tax. There's no tax that's paid by the business entity. So these four factors will often influence exactly which of the partnerships or the corporations or the LLC that we will talk about. So the first form that we have is sole proprietorships. Sole proprietorships are the most common and the simplest corporate form that's available. This is really the default form when there is only one person that owns the business. So a lot of mom and pop stores are considered sole proprietorships. I spoke to someone earlier this week about helping them out in a potential EEOC discrimination claim that they have. And when I was asking what type of business they had, the person said, I don't know, we just have the business. And so they had never gone through and selected a corporate form and had followed the documents to create an LLC or a S corporation or a C corporation. Instead, they were operating as this default business of a sole proprietorship because there was only one owner. If there had been more than one owner, as we'll see in just a moment, then the default is a general partnership. So when you just have a mom and pop store that decides we make really good pizzas, we want to open our own restaurant, and they go out and they just rent a building and they sign contracts to rent it, and they buy an oven, and they buy all the kitchen equipment, and they buy tables and chairs and plates and dough and all the ingredients that are needed, and then they open up and they start selling pizza. If they didn't go through any process to create a formal entity by law, then the default is that they have just opened a sole proprietorship. So in a sole proprietorship, one person owns that business, and that person has personal liability. That means that they are personally responsible for paying the debts of the business, they're personally responsible for paying the contracts, and they're personally responsible for paying any tort liability that they have. So if we take the example of the pizza place that's opened, if you have a customer who comes in and slips and falls and sues the business, the restaurant, for negligence, and they go to court, they have a jury trial, and they win $50,000 against the pizza restaurant. As a sole proprietorship, there's no shielding or insulation to protect the business owners. They're going to be personally liable for that $50,000. And if the business doesn't have the $50,000 to pay that judgment, they could be personally liable, meaning that the plaintiff, the person who won the judgment, could come after and try to collect from their personal bank accounts, from their retirement accounts, from the equity in their home, things such as that. So personal liability is a very big concept, and is something that the different types of organization we're going to talk about, some of them offer protection from the personal liability. And when it offers protection, that means that typically the only assets that would be available to pay that potential judgment would be the assets of the business, not of the owner's personal assets. But in a sole proprietorship, the personal assets of the owner could be subject to the debts, the contracts, and any tort lawsuits of the business. So, like I said, this is the default form, meaning that you do not have to complete formal paperwork. If you just go out and you set up your business, like the pizza restaurant, then you have a sole proprietorship. A sole proprietorship, the business would terminate upon either closing it or the death of an owner. Those are the typical ways in which a sole proprietorship terminates. Now, a sole proprietorship may pass on to, if the pizza business is running well and the dad leaves it to a son, then it would then become the son's business and he's the sole proprietor of it. And so the advantages of these are they're the simplest, they're the quickest, and the cheapest. You don't have to prepare anything. It's simple to set up. It's the quickest in that there's no required paperwork to be filled out or documents to be drafted or things to wait on the state to do. And it's the cheapest because you don't have to pay a lawyer to help draft anything. You don't have to pay any filing fees with a state. Tax is simple because this is a pass-through entity, meaning that all the profits are reported on the owner's personal tax returns. It's a single level. There is no business tax paid. So the restaurant in our scenario would not pay any tax. All tax on any profits that were made would be paid by the owner of the business. So, and in the sole proprietorships, as the name would imply, sole, there's only one member. There's only one person in the ownership chain. If you have more than one owner, then we go into the partnership. So partnership, general partnership, this is the next default. So sole proprietorship is the default when you have one owner. When you have an association or collaboration of two or more people to carry on a business for profit, then they've created a general partnership. And this is the default form. So again, like a sole proprietorship, there's no requirement that you um, file any documents with the state or that you undertake any certain uh, task to create the entity. Just again, if instead of it being one person decides to set up a pizza stand, if you've got two brothers that decide to set up a pizza stand, they go in, they create the business together, they're operating a general partnership unless they elect to set up their restaurant as some other form of business entity that we'll talk about uh, later on. So in that example, you've got the two brothers, they go in, they decide to carry the restaurant. They're going to decide, um, one brother may put in all of the money to help um, rent the place, to buy the equipment, to hire the staff, to do the advertising. One brother may contribute all the capital, all the money needed to get the business up and running. The other brother may contribute his talents. He may only come in and he has the background in cooking, and so he's going to design the menu and he's going to help uh, do the cooking and training the workers, and he's going to oversee and manage the restaurant. Uh, that's his contribution. And so you've got the two coming together and contributing. And as a partnership, to be a partner, they would each have to share in the profits. The one brother can't contribute all the capital, and the one brother perform the services, the management aspect, and that the brother who's doing the management is going to be paid $10 an hour. In that instance, he's receiving wages. He's really an employee. He's not a true partner in that restaurant. It would be a sole proprietorship in that example. But if the brothers come in and they agree that they're going to uh, do the business themselves and they're going to operate it, they're both going to share in the profits and losses, then it's going to be a general partnership. As a partnership, it is considered a separate legal entity in the sense that the partnership can own, um, property can be in the name of the partnership. You can get bank accounts in the name of the partnership. It's not considered just to be, the individual's ownership. But at the same time, that doesn't change the personal liability aspect, nor does it change the taxation. So the partnership, again, would have no liability. The business you wouldn't go after any assets of the business. Rather, the partners are the ones who will bear any liability for, again, contracts, debts, or torts. So if the fall happens, like we talked about under the sole proprietorship example, they're still going to come after the owners and not the assets of the business. And that's because the partnership is not recognized as a separate form of legal entity that would be responsible for its legal liability. So partners are going to, again, have personal liability in this scenario, the same as someone that's established a sole proprietorship. Now, the profits or losses in a partnership are going to flow through. This is a pass-through entity. They're going to flow through to the partners. So again, this is a one level of tax arrangement. So the business is not paying any tax on any profits. The profits are only being taxed on the owner's personal income taxes. So the key advantage with a partnership is flexibility, because partners can basically draft any agreement that they want. They can decide how to share the profits any way they want. If one's going to get 60 and one's going to get 40, there's no problem with that. If one's going to get 90 and one's going to get 10% of the profits, nothing wrong with that, because the partners are allowed to pretty much craft any agreement or contract that they decide, as far as the ownership aspect, or excuse me, the operation aspect, as well as the profit sharing. The only real limits would be that you couldn't have an agreement that would be illegal or against public policy. So you have the general partnership, and then, as we'll see over the next couple of slides, there are two main variations of it. You have limited liability partnerships, which these are typically reserved for professional type businesses. So the most common ones you see are accounting firms would be established as a limited liability partnership, and law firms are usually established as a limited liability partnership. So those are the two biggest types of businesses that would use or opt to use in limited liability partnership. That doesn't mean that every law firm or every accounting firm is an LLP. There are many that choose to be incorporated in some other form. Our law firm, for example, is a PLC, and we'll talk about that later. So the main advantage with an LLP is that it limits the liability of the partners. So in a law firm example, this is the best example I can give because I work in a law firm. In a law firm, you are partners. So if there are, say, 20 partners in the law firm, you would have 20 people that could, in a general partnership, you'd have 20 people that would share in the personal liability. In a limited liability partnership, there you are limited against the liability for the actions of another partner. So if I have use the example of a law firm, and I'm in this law firm, and Chuck, another partner in the law firm, if he commits malpractice, let's say he has a lawsuit and he forgets to file a document by a certain deadline, and his client is not going to be able to recover any money now because Chuck missed that deadline. That would be malpractice by Chuck because he had a duty, an obligation to file the document needed to allow his client's claim to continue. Because Chuck failed to file the document on time, the client has suffered damages, whatever the value of their claim was. So in that example, the client would have a malpractice lawsuit against Chuck. In that example, if in a limited liability partnership, even though Chuck is my partner, I am not liable for his liability. Rather, the liability would be left solely to Chuck. So if I was the one who committed malpractice, if I was the one who missed it, then I would have unlimited liability for my wrong actions, for my malpractice, and Chuck would not have any liability. If Chuck's the one who commits malpractice, he has unlimited liability for his wrong, but I would not have any liability for that. So as you can see, the limited liability partnerships provide some protection against vicarious liability of another partner. You still have unlimited liability for your own mess ups, but you are limited and protected against the mess ups of another partner. And these forms are still treated the same way for taxation purposes. It's still considered a flow-through, pass-through entity. So there's only one level of tax. The business will not pay any tax. Any profits or losses instead are reported on the personal income taxes of the partners. Limited partnership, this is the second form of partnerships that you may see. In both of these forms, the limited liability partnerships and limited partnerships, both of these require that you complete specific documents and file them with the state agency. In Tennessee, you would file these documents with the Secretary of State. So for a limited partnership, you're going to have to make it known by filing those appropriate documents with the state agency. And what exactly those documents are may vary, will often vary, at least to some small degree, from state to state. So the main advantage of these limited partnerships is that you have people who are known as general partners and limited partners. General partners are the ones like we've been discussing where they remain personally liable for the partnership obligations and debts, and those are the ones who are responsible for operating and managing the partnership. Limited partners are just like you would expect. They're limited in the scope of liability as well as their involvement. So a limited partner on liability, they have no personal liability beyond whatever they contribute. So if they come in as a limited partner and contribute $50,000 to the business, the extent of their liability is $50,000. They may lose their investment but that's it. If they've invested $150,000, but then there is a judgment for $1 million, the most that that limited partner is going to be liable for is his $50,000 that he contributed. And then as a limited partner, they don't have any responsibility or involvement in managing and operating the partnership. So these limited partnerships, their main value and the main reason for having a limited partnership is it allows you to raise capital, because investors find this form of partnerships very advantageous, because most people that are just looking to be investors, they want limited liability and they want no involvement in management obligations. And so for somebody that's looking just to strictly invest in what they believe to be a good business, they like the ability to invest and not be subject to any personal liability, because they don't want to put their money in something and then take on substantial or potentially substantial personal liability. And people that are investing are usually just that. They want to just provide their money to help the business, but they don't want any part of managing the day-to-day operations.